Welcome everyone to today's video in which we're going to talk about SOFI stock because they are reporting earnings tomorrow, and if you guys have been following the channel for about a year, you know that I was recommending buying SOFI at around $6 or $7 per share. Obviously since then, that investment has done tremendous for us as we have recorded gains of over 300%, so today I want to share my thoughts on earnings and the company in general. Now the reason I was very interested in SOFI is because this growth was amazing. As you can see, the revenue growth has gone from $506 million to $3.2 billion over the last 7 years or so, and they are growing at around 30% annual revenue growth, which is insane. Now the same goes with their profit. As you can see, this used to be a non-profitable company, but since we got interested in that company, they were profitable, and they are now generating $640 million in net income. Now regarding this company, we have to completely ignore free cash flow because banks report their earnings in a different way, so you need to focus on net income when valuing banks. And SOFI also has seen insane growth regarding their members and products. As you can see, they have grown members at a compounded annual growth rate of 50%, which is insane, and products at a compounded annual growth rate of 52%. And although they are listed as a bank, it is more like a financial super app where you have everything in one. You have your checkings and savings, your loans, your credit score, your credit card, and as we've said before, they currently have 12.6 million members. This is why if we take a look at the financial forecast, it is no surprise that analysts still have a lot of growth for SOFI in the upcoming years, growing still at high double-digit revenue growth, and profit is expected to go from 59 cents per share this year to 83 cents per share in 2027. And I completely agree with analysts, especially on the profit side, because as they grow more their revenue, their profit is going to increase as they have very good margins. As you can see, profit margin is currently at 19%. So everything looks fantastic for SOFI. I mean, if we take a look at their last earnings, they even increased guidance. Before they used to guide for 30% revenue growth and now 36%. In terms of adjusted EBITDA from 28 to 29%, and net income from $370 million to $455, which is 13% upside. Now I'm going to explain the reasons why I sold the majority of my position, which might surprise some of you because as we're seeing, everything looks fantastic and is still expected to be fantastic. So I'm going to explain the 3 main reasons why I decided to sell almost all my position. And reason number 1 is share dilution. As you can see, SOFI has been increasing the number of shares outstanding, not by a little, but by a lot. As you can see, last year they increased it by 15% and the year before by 16%. This is horrible for investors because you own less of the company and you're sharing the profits with more and more people. And while this is common in small tech companies that have a lot of growth potential, I don't really see why SOFI does it as they have a very good balance sheet and I don't see the need to raise money. As you can see, they have $3 billion in cash and $2.8 billion in debt, which is manageable for a company that now has a market cap of $31 billion. So I don't really see this necessity. And if you're serious about value investing, you have my code at stockanalysis.com in the description, because you know that you have to back your story in investing with the numbers, and stockanalysis.com has everything you need. Now, reason number 2 that I've decided to sell is because of the valuation that has gotten a bit expensive. The current PE and forward PE are 45. I mean, this is not egregiously expensive, but still a bit expensive. And in order to take a deeper look at the valuation, I use my discounted cash flow model. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $10 per share, middle 18, and high 31. Which also means because the stock is currently trading at around $25 per share, that if my low assumptions occur, you would get a negative 4.5% annual return on your money, middle positive 5%, and high positive 13.5%. So again, I don't think the company is egregiously expensive, but still a bit expensive according to my assumptions, and I think they are reasonable as they have SOFI growing revenue between 10 and 18% over the next 7 years, averaging a profit margin and free cash flow margin between 15 and 25%, and I assigned a PE at the end of the 7 years of 18, 20, and 22. But as you can see, I didn't assume any share dilution, and if we go back and put our 10%, annual return for intrinsic value. The reason I put 10% is because that is what the market gives you. And if we assume they issue, let's just say 2% of their shares, although they've been doing a lot more, for the next 7 years annually, as you can see, the intrinsic value decreases substantially. And the last reason is that because I got around 300% returns in a year, it is hard not to take the profits, and that combined with the share dilution and the current valuation is what motivated me to sell the stock. But let me know what you think about my decision and what you are currently doing with SOFI stock in the comments. I hope you found this video valuable. Check out the links in the description in case you're interested in the spreadsheet or stockanalysis.com, and I'll see you in the next one.